Hello, Ed Denny here. Thank you for joining me today. I hope you had a good week last week, good weekend. Those of you who celebrated Palm Sunday, it was pretty nice weather around here. We've actually had a very moderate winter. We haven't had any snow, just a couple of dustings. And it's been relatively warm. It's just been overcast and rainy quite a bit for the past few months. Now in April, we've gotten some really nice sunny days, but it's still cold out here. But spring is coming, and in the spring there will be growth, as Chauncey Gardner once said, in Being There. For those of you who didn't see that movie with Peter Sellers, it's worth reviewing again, especially in light of the current debate about whether we're going to have a recession coming up here or whether we're going to have a continuation of growth. So I'm with Chauncey, believing that the economy will continue to grow. There's a lot of concern since the banking crisis started that this is just sort of a slow motion affair that will increasingly lead to a credit crunch and a recession. So the pessimists, the bears, haven't given up on that story. It's a plausible story. I'm not telling you it's wrong. I'm just saying that, in my opinion, the likelihood is that the economy will continue to grow. Let's put that 60%, and 40% that it won't. So I think I'm being quite reasonable here in arguing that, conceding, recognizing, acknowledging that there is a substantial recession risk here. But that's been the case really since the beginning of last year. And I've been arguing that we actually are in a recession. We've been in a recession since early last year, and as you probably getting tired of me saying so, it's been a rolling recession. Hit the single-family housing, did not hit multifamily, hit goods retailing once the consumers had their fill of consumer durables and they now wanted to travel. So the services economy has been very strong. Yes, now we're probably going to see more of a recession in commercial real estate. That sector is very dependent on credit availability from smaller banks, from regional banks, and they most likely are going to be cutting back on that sort of lending. But even before all that was happening, commercial mortgage real estate rates had gone up substantially, making it less conducive to a continuation of a strong commercial real estate market. So that's where we are. Oh, just looking to make sure that on the Q&A, there was nothing odd. So I guess you're all still hearing me and seeing me. Look, last week, the week before, it's a strange situation. It's every day that nothing terrible happens in the banking industry is a good day for the stock market. This is a case where no news is good news, even very good news. Market's done extremely well. And again, there's still this controversy about whether the rally since October 12th is just a rally in a bear market or whether it's the beginning of a bull market. I think it's the beginning of the bull market, but I don't think it's a V-shaped bull market the way we're used to seeing these things kind of come out of bear markets, because valuation multiples aren't that cheap. There is still a concern about the earnings outlook. But on the other hand, because of the banking crisis, because inflation has continued to moderate, bond yields have come down substantially from 4.25% on October 24th. I thought that was the high. So far, so good. And now we're down to 3.4, 3.5% on the 10-year. So that's having a good impact on the market, particularly on some of the mega cap technology names. There are people saying, well, this rally is all about the mega cap tech names. It's very narrow, and that's got to be bad. And not if you own them. It's not bad. And meanwhile, if you look at the performance of the market since October 12th, it's been technology, it's been communication services, it's been industrials. It's been pretty good. It's pretty widespread, and to the extent that it's certainly covered a lot of the bigger cap areas of the marketplace. And by the way, since October 12th, there hasn't been none of the 11 sectors of the S&P 500 have been down. They're all up. That's where I'm seeing things. Let's go look at some charts here related to the morning briefing. And we'll go right here. Good. Looks like you can see them, I hope. So April 3rd, that's today. Pay no attention to these numbers. We got to fix them. I think they're kind of messed up. But the main point of this thing is this is real GDP on a logarithmic scale, ratio scale. By the way, it makes an important point here, and that is, I've been occasionally accused of being a permeable, and my response to that is thanks for the compliment, because I wouldn't mind on my tombstone if it said Eddie Ardeni was usually bullish and usually right, and that's simply because optimism has worked since World War II. We've seen the economy continue to expand, and on a ratio scale, you can barely see these recessions that we all get so excited about. I mean, clearly some of them were terrible. This one was certainly a bad one, and the market took a huge dive back here. So I don't want to dismiss this, but let the trend be your friend. We still have the trend on our side here, and for all the talk about a recession that started last year, the economy has continued to grow. We are seeing that the Atlanta Fed's GDP now tracking model is tracking, I think, at 2.5% at an annual rate for the first quarter. That is down from 3.2%. But the consumer, which a few estimates ago was tracking at a 5% annualized real rate for consumer spending, is now, I think it was like 4.8%, something like it, maybe 4.5. Anyways, it had a 4 handle on it, and it was pretty impressive to see the consumers continue to spend like that. They had a really strong January, then they kind of faded a little bit in February, not much. And so, as you know, they take January, February, March average and compare that to the fourth quarter average. And right now it's tracking at a very strong pace indeed, keeping the economy growing. And by the way, some of that spending was actually in goods. It wasn't just this pivot toward services. So maybe some consumers are starting to get a hankering for some goods as well, particularly durable goods. This is the coincident indicators. I did most of the morning briefing is sort of focused on 1990 versus 2023. In 1990, before that and after that, there was the savings and loan crisis, and the industries basically imploded. There was a lot of, not a lot, but there were some S&Ls that went a little too far in terms of raising their interest rates to attract deposits. They had been deregulated, and so they went wild in offering very attractive deposits, which brought in a lot of funds. And then they leveraged them up into commercial real estate lending and other things like that. And when that market started to come unglued, that created a lot of problems for the S&Ls. They had to be consolidated. They had a lot of assets that weren't worth that as much as they bought them for, and they had to be sold through something called the Resolution Trust Corporation. You can read all about it in my book, Predicting the Markets. It's kind of everything I've lived through in the past 40 plus years. I'm gonna have to update it for another 40 years, I guess, the way things are going. Always an interesting time in our business. Well, again, in 1990, we did actually have we didn't have a official economic recession. We did have a decline in earnings, which is rather substantial because the financial sector mattered. And that back then, we didn't really have a bear market. We had, you can see this is what we had. We had a 10.2% drop over 28 days at the beginning of 1990, and then it rallied, as you can see here, and then it took another dive of 19.9%, so just shy of a bear market. One of our accounts pointed out to me that if you look at the equal weighted S&P, is actually down by over 20%. So I'm not telling you there wasn't something that felt like a bear market here, but from an official 20% or more decline perspective, the S&P 500 didn't go there. And the recession that occurred back then was a very mild one. It only lasted 8 months, but it was kind of a lingering thing because the S&Ls continued to be restructured and continued to be sort of the walking wounded. But there are similarities to now. The small community banks, the regional banks. So far, we're seeing is a few of them committed some financial excesses. It's not clear that we have a whole bunch of Silicon Valley banks out there that attracted a lot of deposits that weren't insured and put that into loans for startups. And so that whole model sort of came unglued. But so far, as I said at the beginning of this little chat, every day that there isn't anything terrible coming out of the banking system is a good day, to the extent that there are people like myself who recall what happened in the 1990s. There's a lot of us who certainly recall what happened during the great financial crisis. And there's always that kind of lingering concern that, you know what, the yield curve got it right again. It inverted. The inversion predicted that something would break, something broke. And now the next thing that happens is you get a credit crunch and a recession and a continuation of the bear market. That's not my story, but based on recent history, it's a plausible fear. There's a few reasons that I'm not in that camp. One is I think we've been in this rolling recession scenario, and we've seen something similar to that in the past. Basically, in the mid 60s and the mid 80s and the mid 90s, and then 2014, 15, 16, we had these kind of rolling recessions where the economy slowed because some sectors took it on the chin. Another reason is I think that there's something going on with the consumer that has something to do with me. It's all about me. Well, what I mean by that, it's all about my generation, the baby boomers. I'm still working for a living, but more and more of my friends are retiring. And what are they doing? They're spending money. I guess they figure, why leave it all to the kids? Why not have a good retirement life? And so a lot of them are traveling, constantly asking us to join them for meals in restaurants. And as a result, we have this tremendous booming demand for employees in the restaurant industry. And when they're not going for early bird meals or just going out for dinner, they're checking in into the doctors in the hospital just to make sure that everything's still working. And so we've had a tremendous demand for healthcare workers. So I think what's going on here is the baby boomers are doing it again, having an outsized influence on the economy. And that might explain why we're seeing some strength, and a lot of strength in the labor market in baby boom related industries that cater to their needs of seniors and so on. Back here, we have a chart on home mortgages, and you can see that that's hasn't gone through this kind of calamity. It looks to me as though we may be seeing the bottom in housing. Again, that doesn't mean a V-shaped recovery, but it does mean that mortgage rates have, well, they stopped going up. They haven't come down as much as government bond yields because of the flight to quality, the risk-off characteristic. But for the 10-year bond yield stays down here around 3.5%, there's room for the mortgage rate to come down and to entice some people back into the housing market. They're not necessarily going to get lower prices. That's another reason why the consumer is so strong. Is we've never had a generation like the baby boomers that on a per household basis had more wealth than any other previous generation. And a good part of that is in real estate. And we'll see that in a minute. Meanwhile, yes, we could certainly have a commercial mortgage borrowing drop as some of their lenders become distressed and or just simply more cautious. And as the developers themselves conclude that the math doesn't work with interest rates where they are now. So here is again a story about the rolling recession. You're looking at single family housing starts in the first chart and multifamily housing starts in the second chart relative to their they're comparable series in real GDP. And we certainly have had a recession in housing. It's not this kind of calamity, but it's a garden variety recession in housing. On the other hand, the multifamily is still doing extremely well. Just an example of the rolling recession ID. This is from real GDP. They don't have, got to fix that spelling. We don't have that commercial by itself. We got commercial and healthcare. And you can see that back in 1990, there's a pretty significant recession there. But, you know, these things happen from time to time. Commercial real estate is very cyclical, and it's probably going to get hit here. But the offset could very well be the construction of manufacturing plants, infrastructure related to transportation. A lot of this is getting some support from the government infrastructure spending program and the CHIPS programs to build semiconductor plants. What are we looking at here? We're just looking at the S&P 500. I mean, you know, for all the anxiety here, we're up from 666, you know, to something like 4,000. That's pretty good, even though we've given back some of it. But again, let the trend be your friend. I mean, there's some really smart people who managed to exactly call that top. But if this is in fact the bottom, very few of them call that bottom, and some of them are still fighting it and saying, no, we're going to retest it and go lower. So here's the story on the banks. We've been following that on a weekly basis. Suddenly our late afternoons on Fridays aren't the time for starting to decompress. Instead, we're going to the H8 release that the Federal Reserve puts out on bank assets and liabilities, weekly data. And as you can see that this is the commercial real estate lending by all banks. It's $2.9 trillion is what they hold. And you can see that the small banks are bigger than the large banks in this particular area of lending. And this is just another slice of that very same ID. This is just what I was just talking about the baby boomers. The oldest ones turned 65 in 2011. They're retiring. So the ones that are not in the labor force have increased to 46.6 million. I think it's up about, 11, 12 million since this point. And you can see that the pace at which they're retiring, of seniors retiring or turning 65, has certainly increased. And again, I'm just thinking about myself and my friends and what everybody's doing. And, you know, I won't say everybody, but a lot of baby boomers have done quite well over the years, accumulated wealth, and now retiring. And guess what? They're spending some of that wealth. They're not just living on Social Security, which might have been the case for the previous generation. Disposable personal income, that was going down in real terms here with the inflation outpacing wage increases. But you're starting to see that real wages are starting to pick up here. It's not real wages, it's real wages and it's employment. And so all I'm saying is that inflation adjusted, we are seeing that things are picking up here on disposable personal income. And you want to look at the real because that's what drives real consumption. The nominal has obviously been affected by inflation. This is another slice and dice of consumption. This is real personal consumption in GDP. And you can see here's the goods going kind of sideways. It had that little strong pickup in January, then it kind of went sideways. So all in all, it adds up to a real GDP of over, let me take this person out of their misery. Then you got services, and the services, I know it's hard to see, but get a magnifying glass, you'll see a slight uptrend here. And believe it or not, it adds up to something like a 4 or 5% increase in the first quarter estimate so far based on January and February. So we'll see how March plays out. Household real estate, remember I mentioned that at the beginning of our discussion here about another reason why consumers are doing so well. They're sitting on a tremendous amount of equity wealth. They haven't gotten wiped out the way they did back here. They've got more equity in their homes because they've got less of it leveraged in mortgages. And you can see that here. This is owner's equity in household real estate is now 1.62 relative to disposable personal income. I mean, the numbers are huge. $43.5 trillion in household real estate. That's what the red line is. And then you got the mortgages at 12.5. They've picked up some, but nothing like what we had back here. And as a result, there's a lot of owner's equity, basically a record amount at $31 trillion. So I hope you found that interesting. I always like to think about demographics, especially about the me generation, the baby boomers, myself and my friends. We all think we're special and unique. And one of the things I learned early on that's helped me in forecasting is to realize that, like Peter Lynch once said, look at look around you, look what you're doing, look at what your friends are doing, and then invest in the trends that you see there. So with that, let me go over to the Q&A here, and I don't see anything here. I see one really, really, really long question, so I'm not going to get into that, but I don't see that anybody else has sent the question. Anybody want to do it real quick and keep it short? If not, we'll call it a day. Let me look at this long one. Well, okay, it's the only question, so why not? It comes from Max. What type of investing in this environment do you consider the most attractive for an investor with planning horizon of 5 years or more? Let's just consider stocks. Well, if you're just going to consider stocks, then the answer to your question is stocks. Stocks for the long runs. I agree with Professor Jeremy Siegel that stocks should really not be traded unless you happen to be an amazing trader. I do on a regular weekly basis give you the opinion of somebody I respect highly, who's had a lot of experience trading. That's Joe Feshbach. But our position has always been sort of the Warren Buffett, Jeremy Siegel approach to stocks is the right one. And what stocks bring to your investment portfolio is dividends. I think dividend yielding stocks, you're just holding them and stashing them away, especially for younger people, just makes a whole lot of sense because these dividends keep growing, and you get a better and better return with every year. The problem with trying to call market tops is that you've got to call market bottoms, and by the time you've realized that it was a bottom, it's a year or two later, and then you're getting back where you had gotten out or higher, and you wind up missing on a good amount of dividends along the way. In terms of sectors, we've so far had some winners and some losers in this bull market, which is what we still assume it is. We've promoted the idea of energy and materials as a way to play a rebound in the global economy. Well, they haven't worked out so well. On the other hand, industrials and information technology have worked out very well. And then financials are also part of our overweight ID. They've really gotten a drubbing, but we think we liked them before the banking crisis. We like them even more now. So that's kind of where we'd be looking at things. But dividend yielding stocks you can find across the board for all kinds of sectors. Let's see, there's a little bit more from Max here. Let's assume among the answer options, well, no, it's a little too long, Max. So let me go to Michael. How do you feel about the money center banks' stability? I think they're okay. They've been going through stress tests. They are regulated and supervised very closely. Look, I've said my position on banks before. Banks, I'm a free market fellow, and I promote the idea of free market capitalism. But I think when it comes to bank, they really need to be regulated and supervised like utilities because they're dealing with OPM, other people's money. And when you're dealing with other people's money, it's not yours. And the more of it that you can get and then leverage up into big speculative bets, why not? It's not your money. If you lose it, they lose it. Or the government comes in and bails you out. I think, by the way, that was the big disaster in Lehman, is they should have bailed out Lehman and just fired all the management. And maybe they should have wiped out the shareholders, but they shouldn't have shut the whole thing down. And I think with SVB, they basically did the same thing, but it just was done so quickly and effectively that it didn't have any repercussions. And besides, there's big difference between the size and importance of SVB and what they were doing and what Lehman was doing. So let me see if there's any other questions here. Yes, there are. Sheldon, what's your view on commodities? Commodities have been on the weak side. I kind of like gold as an indicator for the underlying trend in commodities. And it's been going up a little bit here in recent days, but it's basically flat for the past couple of years. The price of copper, it's kind of puzzling that it isn't a lot stronger. Not puzzling, but it's insightful in telling us that the Chinese economy may be picking up, but it's not blasting off. I mean, they still have a tremendous real estate problem, no overhang. They're not going to be doing a lot of construction of residential, but then again, they're pretty good at building roads and bridges to nowhere that nobody needs. Actually, that's what Japan used to do. But they certainly have a lot of state-of-the-art trains and all that. The problem is they're expensive, and it's not clear that they meet the needs of the average Chinese commuter. But in any event, copper's not been strong. Let's see how this oil price goes. I think that the oil price increase that we just saw today, because they cut back production, I think they cut back production not so much because they think they can get it back to 100 and keep it there. I think they got to know by now that every time you get to 100, you destroy demand, and the price keeps coming down. I think in this case, they were seeing a downward trend since June of last year in oil prices, and just didn't want this thing to keep going to the downside. So I think that's basically it. They don't want it to go down. They're not necessarily expecting that it's going to go up a lot. But the overall global economy looks better than it did last summer. Last summer, Europe was supposed to go into recession. China was in lockdowns, and so it looked pretty grim. But then China got rid of the lockdowns, and Europe's had a mild winter. But on the other hand, the banking crisis is not just in the U.S., it's also in Europe. And that might make the lenders a little bit more cautious about lending. And that may put a damper on economic activity on a global basis. Not a recession, just call it a rolling recession on a global basis, or just a global slowdown. And that's augurs for commodity prices not being up much or down much. It's a wonderful thing about our business. It's really pretty easy. There's only three choices: up, down, or sideways. I mean, got to be able to get it right occasionally. Okay, we're almost done here. Let's see. John, are the millennials an even bigger group, spending more increasingly, another tailwind? Yeah, I would think so. You know, the over 50% of people over 16 years and older are now singles. And it's a combination of young people who never got married, people who are divorced, and people who are widowed. We are seeing that the singles who've never got married, all-time record high. And I know from personal experience that if you do get married and you do have kids, you do spend money, and it is expensive. But you also have to save money, thinking about the kids' educations and your own eventual retirement needs. It seems that the millennials might be more carefree in that regard. They're not getting married as readily. They're not having kids. And so they are getting older without going through that kind of phase in their lives. And that probably leaves them with more money to spend on themselves. Let's see. I mean, they should all be putting it in dividend yielding stocks, going back to before. Okay, we'll take one more here from Ian. And then Gus, we'll take two. Bank of America and US Bank are trading at less than 8 times forward PE. What do you think about buying here for long term? I don't do individual stocks. I'm not registered with the SEC, so I'm never going to give you advice for individual securities. But as a general rule, I like financials. I think they've gotten cheap here. And without a recession, with the economy likely to do better in 2024, which is where the market now is focusing on, I think they're fine. Gus, Ed, do you have liquidity until you don't? What should we look at to see that we are not seeing a significant contraction liquidity in the system? I guess that's a good point. I mean, when the market goes up, everybody says there's liquidity. When the market goes down, they say liquidity is drying up. I mean, I don't know what happened exactly on October 12th that suddenly liquidity poured into the market and created that rally. Up to that point, you could say that liquidity was drying up. You could look at M2 measures, demand deposit measures, particularly growth rates, and get very, very concerned. I would say that you got to look at it eclectically, look at whatever you can. So I've got no problems with focusing on the monetary aggregates, but you have to put them in perspective. They've gotten weaker recently because they went way off trend as a result of the pandemic, and now we're kind of coming back to that trend. And I think there's still about $500 billion, maybe $1 trillion in excess liquidity left over from excess savings during the pandemic, from what people stashed away for a couple of months and what people got from the government. I know that. I think Gus, you told me this. You had some information from state and local governments, and that a lot of them are sitting on record rainy day funds. And where did that money come from? Well, it came from all this government support to get us out of the pandemic that they haven't spent. So there's another example of a tremendous amount of liquidity. There's, deposits are still at near record highs. We've got money market funds also rather flush with cash right now. I think I've overstayed my welcome here by a minute. I usually try to make this half an hour. Have a great week, and all the best. Thanks again.